Hi, ladies and gentlemen. I'm Steve Harney. I'm the founder of Keeping Current Manners. And this morning, we're going to do a deep dive on mortgage rates and affordability, the thing I call the unholy marriage. However, before I get started with the slide presentation, I do want to address the litigation that took place last week and future litigation that's already on the books. I don't really have a strong opinion about the litigation itself. That's a brokerage issue. As most of you know, I sold my real estate company. I had 550 agents. I sold that company back in 2005 and have dedicated the last 18 years to helping agents across the country better understand how the economy affects housing. Because of that, I really haven't done a lot of research or a lot of study on brokerage issues, and that is a brokerage issue. So I don't want to comment on that because I don't really feel that I have enough information to have a strong opinion on it. However, I have a strong opinion, let's put it that way. I have a strong opinion on some of the headlines that came out of that. Headlines saying that maybe the real estate industry is over, it's done for, it's not going to survive. And again, I have a strong opinion on that. But let's just sit back for a second and think about this. In order for any industry to survive in this country, it needs two things. It needs a product or service that fills the need of consumer. And the second thing it needs is a consumer base willing to pay a fair market value for that product or service. If you have both of those things, the industry will not only exist, it will prosper. So let's take a look at real estate. Over 90% of the people that buy or sell a house use a realtor. We fulfill a need. There's no question about that. So number one, check, that's done. Number two, for over 100 years, people have paid us a fair market fee for our service for the things that we do. So yes, we have plenty of customers, about 5 million a year agree to do that. So again, going back to the rule, the two things you need is a product or service that fills a need and a strong customer base that's willing to pay a fair market value for that need. Neither one of those two things have changed. Will the industry evolve? It definitely will. Like it's been evolving for the whole 45 years I've been in it. And who is going to do the best? Person has kind of two traits. The first trait is they don't worry about things they can't control. And the second thing is they work hard every day at what they can control. As far as how this is going to impact you, let your broker, your leader, your MLS, whoever you're looking for guidance for, let them decide what's the best way to handle it and then follow their lead. What you should be doing right now is going out and finding a person or family that's looking to buy or sell a house. They need your help. Let's concentrate on helping people because that's what we get paid for. We're in a great industry. If we want to make a paycheck, we have to help someone. If we want to make a lot of money, we have to help a lot of people. Let's, again, not worry about what we can't control and really dive into what we can control. And with that, let's start the deep dive. This is mortgage rates and affordability and unholy marriage. And things are really, on the mortgage rate side, things are a little bit crazy right now. To get started, I love this quote from Sean Dobson, the CEO of Amherst Homes. He said, we're just at a point in the housing market to where I don't think anyone really knows to tell you the truth. Someone asked him for a forecast, and that was his answer. And that's probably the most truthful answer anyone's given in a long time. No one really knows, ladies and gentlemen, about what's going to take place next. Things are kind of volatile. But again, we can't control that. What we can control, are we going to prospect today? Are we going to go out and do the things that need to be done today in order to build business? And the way we build our businesses, we help people. And the more people we help, the more people they refer us to help them. All right? As we always say here, most agents know what's happening. Good agents understand what's happening. Great agents can explain what's happening. So let's take a look at affordability, and let's do a deep dive on that. NAR has a methodology where they have, over decades, look at the median priced home versus the median price income. And they've come up with a system, an index, that at 100, people can afford to purchase a home. The majority of people in this country can afford to purchase a home. That black dotted line going across, that is the 100. That's the index. Anything above that, affordability is good. Anything below that, affordability is not good. What we can see from 1990 all the way from 2022, on an annual basis, houses were affordable. That spike up toward the right-hand side of it was during the housing crash and thereafter, where there were so many foreclosures, it drove prices down, and that increased affordability. The reason it stayed high all the way up until last year is after the housing crash, mortgage rates just dramatically fell off the charts, down into the twos at some point. And that it also increased affordability. So what we're looking at is we're coming off of, almost 30 years, actually more than 30 years, of affordability being not a challenge in the country. Now, all the way to the right, that orange bar, that's us today. It takes time for NAR to figure out, do the calculations as far as, they have to do the income calculations, they have to do the pricing calculations. So August is the last month they reported on. So I don't want you thinking that's old data, it's the most recent of data. And probably in September and October, that orange bar might even be a little lower, because mortgage rates were still high and prices are still going up. But again, here we are, Monday, November 6th. Last Friday, crazy things happened in the mortgage market that we'll talk about in a second that might impact affordability or might not. Now, this is over the last, what I'm showing you here, over the last 32 years. Let's just take a look at this last year or last year and a half, going back to January 2022. What we can see, it's been like a roller coaster ride to some degree. At the beginning of January 2022, we can see that the affordability index was high because rates were still low. As rates started to climb in April, May, and June, the affordability index sank. Then as rates went up and down, and also prices started to be impacted in October, November, and December. So affordability was okay. Now, moving forward, we can see that prices have remained value and appreciating moderately, and interest rates have kind of leveled off. So we're seeing the affordability index level off, but it's under 100, meaning more and more families can't partake in the American dream. And if we take a look at it number-wise to understand their pain, we can go all the way back to January 2021, and that's the monthly mortgage payment on a median-priced home. And what we can see is that number has skyrocketed over the years, right? And that's the affordability issue that we're talking about right now. And it's brutal. There's no question about that. Now, part of the reason they went up as quick as they did, the monthly mortgage payment, is we had rates at 2% and 3% through 2021. So the affordability was great then. So it's not just that the mortgage payments are much higher. It's that it was almost a shock to the system that they were higher. Probably a more accurate depiction of what's taking place is this. All right. What we have here is something a little bit different. This is assuming there's a 30-year fixed rate mortgage with a 20% down payment or a median priced home, what percentage of the median income goes to paying the principal and interest payment? And what we can see, the number that we want to look based on NAR's methodology, we want to look at 25%. And again, going back to January 2000, we can see all the way up to just recently, we were below that 25% mark. When we hit the peak during the Russian prices in the mid 2000s, we still didn't hit the 25% mark. It was 24.7. We touched it, but we didn't go over it. Now, if we go all the way to the right-hand side of this chart, we can see that right today it's 27.3%. So though we're much higher than we were, say, in January 2013 in the middle of the chart, that's because mortgage rates were so low then that there were unreasonable, affordability was at an unreasonable level on the good side, on the affordability side. What we need to do for homes to be available is not to go back to 11.6%. We have to get that 27.3% back down to 25%. That's normal affordability. People are not going to feel that way about it because they're kind of used to having 11% or 13% affordability. But affordability really is they're paying 25% of their median income to the principal and interest payment. So we're not that far off when we look at it this way. And what we need to do today in a really, big way is make sure, understand what are the pieces of the equation and what's going forward with that. So the affordability has three parts: wages, mortgage rates, and home prices. Each of them have a piece in determining where affordability is at. So let's look at them individually. Wages, which have been stagnant for decades, right, have not really played a major role in the affordability index or making it more affordable to purchase a home, is showing some signs that it might help a little bit. These are wages. This is the index of aggregate weekly payrolls of all employees, total private. And what this shows us, according to economists, is this gives us a good feel for where wages are. I'm not going to get to the weeds on that because I'm not an economist. But if we take a look at the trend line, that blue dotted line going through, we can see that is where wages have gone, and they've gone up with inflation or below inflation going forward. But that's the trend line. And we can see all the way to the right that since 2021, they're actually going above that trend line, meaning wages are getting a little bit better than they had been going all the way back to 2006, the first number on the chart that we had available. So what we're looking at, yes, wages are a little bit better. There's no question about that. We don't know if they're going to maintain or whether they're going to stay better. And it's really not that much of a difference that I think it's going to matter as far as the affordability index. But let's go to something that is mortgage rates. Here's a chart of mortgage rates that show you, first of all, if you take a look at 2016 all the way to 2021, that's all the lines toward the bottom. And we can see that for all those years, from 2016 through 2021, mortgage rates were under 5%. That wasn't normal. That wasn't the normal average. So we had many, many years of below average mortgage rates. But when you have many years of it, it becomes the expectation. So now people expect, millennials and Gen Z, they kind of expect it. Well, why isn't it 5%? And they got a culture shock, as the rest of the country did, in 2022, last year, when rates skyrocketed and really caused a big drag on affordability. And then that red bar all the way at the top is this year, which is even higher than last year. And if we look at it historically, what we can see is if we go all the way back to 2016, we can see that where we stand as of last Friday, 7.38%. And the 10-year Treasury jumped up a little bit this morning, so I think that number might jump up a little bit this afternoon. But as of November 5th, last Friday, it was at 7.38%. And we can see that compared to the last several years, that's much, much higher. That's that rate shock that everyone experienced that pushed everyone back toward the fence and deciding, should I buy, should I not buy, should I sell, should I not sell? Now, if we look at that number across decades, we can see that the number is not way out of whack. So I don't want people thinking that we're going to go back to the 2 and 3%. That was the anomaly. Our hope is that we get back to somewhere between 5.5% and 6.5%. And who knows if that's even going to happen. Again, no one can predict what's going to happen going forward right now. Things are crazy. But I do want you to see that the 7.38% is lower than previous decades. Now, of course, prices were less expensive then, but also wages were a lot lower then too. I'm not trying to compare the affordability issue with this graph. I'm just giving some historical perspective as to how people could feel about 7.38%, since any time in this century, that's a number higher than where we were. Mortgage rate stability, even if the stabilization occurs with rates at a higher level, is the key to an eventual housing recovery. That's from Odetta Cushy from First American, and I agree with that. I don't think that if they stabilize at 8.5%, it's going to be good for eventual housing recovery. But if they do stabilize somewhere under 7, I think it's going to be fine. Maybe even at 7.5, because people will get over the culture shock. But again, what we need to do is we need that 25% of their median income handling the mortgage and interest payment. Okay, that's what we really need. What are projections, mortgage rate projections going forward? Well, here they are, ladies and gentlemen, for the fourth quarter from the Fannie Mae, the Mortgage Bank Association, and National Association of Realtors. The average of all three. Now, if you would have showed me this chart 3 weeks ago, I'd say that's crazy for the fourth quarter of 2023. But then again, last Friday, there was 7.38%, so maybe it wasn't that crazy. Mortgage rate projections over the last couple of years has been way off. Most times they've been way too high because mortgage rates kept on dropping. Then it just got to the point that nobody really knew what was happening. And I think we're still at that point. No one's really quite sure what's going to happen next. But I did want you to see what the mortgage projections are going forward. What's my opinion on that? Well, this is what I can tell you. My opinion is not worth any more than the guy who's cleaning the kitchen in our executive offices right now. No more. Nice guy, doesn't really know anything about housing, but his guess is probably as good as my guess because nobody knows. The person pulling the levers, Chairman Powell, he's not sure what this all means. So there's no way for us to know. So I'm giving you the projections the best we have at the moment, this moment in time. And I think that we're going to end up somewhere in the low 7s toward the end of this year, hopefully. And I do believe that by the end of next year, we're going to be in the 6s, which I think is going to open the market in a very big way. The bottom line is that interest rates are likely to be lower, perhaps even lower than many optimists think, in the weeks and months to come. A year from now, I think it's more likely that not that mortgage rates are back under 6%. But let's say that again. It's more likely than not that mortgage rates are back under 6%. This is from Aziz, strategist of economics. Is it wishful thinking? I don't know. He feels very, very strong, and he makes a great case in his papers that mortgage rates will be under 6% by the end of next year. Home prices. This we have a little bit more definiteness on. All right, here's the latest Case-Shiller report, the Case-Shiller numbers, and it goes all the way back to January of last year. And we can see, as we said, every single time that we've shown this graph, appreciation was out of control in the first 6 months of 2022. A correction had to take place, and it did, the second half of last year. And now we're back to more normal appreciation numbers. Now, these are seasonally adjusted, and there was a lot of surprise that the August number jumped up to 0.9%. All right, jumped up, not down, because later in the year, usually prices fall, which we'll show you in a second. So as far as the pricing piece of the affordability equation, well, there's a lot slower appreciation than was last year, but there is still appreciation. Now, when I show you the August number, you might turn around and say, well, listen, what about October? What about September? What about October? Ladies and gentlemen, this is a repeat sales index, meaning that they have to look at the house that sold and compare it to that house and other houses like that house that sold over time. The methodology is a little bit detailed. You can look it up if you would like. But what it does is it takes them time to come up with a number. But their number is so much more accurate than the median price number. The median price number, in my opinion, for sales prices, home values, is virtually worthless in a rising mortgage rate environment. All right. And we've explained that in the past. So the reason that I like using the repeat sales indexes is very simple. They're much more accurate. So I had to make a choice. Am I going to be quick and wrong? Or am I going to take a little time, be patient, and be accurate? Obviously, what we decided to do is take a little time and be more accurate. Now, let's get back to seasonality with prices. This is the normal seasonality over the last 49 years. I've shown you this graph before if you've done other deep dives with us. And what we can see is appreciation accelerates early in the year as the buying season comes about. And then once the buying season comes over and we hit summer, for the rest of the year, month over month appreciation decelerates. It doesn't go to depreciation, not the average. It decelerates. But if we take a look at November and December, we can obviously understand that if the average is only 0.1%, there were some years that have jumped into red. And we might have one of those months this year. But it doesn't mean houses are crashing. It means there's a normal deceleration of appreciation, and there might be a month that we drop a little bit into depreciation. Where do we stand against this index so far? Again, non-seasonally adjusted numbers. The 49-year average, again, is the black bars. The green bars are what's happened every month in 2023. And as we can see, we started the year below the 49-year average. Then we jumped above the 49-year average. And now we're settling back in almost to exactly the 49-year average. And I think that will continue through the rest of the year. So what does that mean? I don't think wages are going to have a big impact, maybe a minor impact, but not a big impact on affordability. I think mortgage rates, it's kind of a crapshoot. We don't know what impact it's going to have. Obviously, if mortgage rates do slide downward, if they moderate, especially if they moderate dramatically, it's going to have a gigantic impact on affordability. But we don't know if that's going to happen. As far as prices are concerned, I'm glad we're away from that runaway appreciation we saw over the last 2 years. I'm granted it built a lot of wealth for people, but it also made homes unaffordable for a lot of families. So I'm glad we're away from that and getting back to more normal appreciation levels. Because over time, houses will then become more affordable. But we have to think about how we can make things more affordable to someone looking to buy a house right now. We can't wait a year or 2 years or 3 years. There are people that are ready and willing to buy right now, but they're just not able. And it's our job as real estate professionals to help those people. So what are other things that we can do? Can multi-generational living be an answer? Ladies and gentlemen, I think so. I think we can help people at least get into the game of owning a home that's building equity, even if it's in a multi-generational setting. Now, I get it. There are going to be some people on this deep dive saying, live with my mom and dad? Are you crazy? No way I'm doing that. And there are other boomers on this call saying, live with my daughter and her husband, my son-in-law? No way, you're crazy. I get it's not going to be for everyone. But I don't think we should shut our eyes to an opportunity to help people achieve homeownership, nor shut our eyes to an opportunity, but helping people we can increase our transactions just because we don't see it the way other people might see it. And how do other people that are living in multi-generational homes see it? Well, actually, Pew Research did a study on it, survey on it. They asked percent who find living with adult family members to be what, blank, most of the time. 58% of the time, people living in multi-generational houses found it convenient. Well, actually, that kind of makes sense. If you're a young couple with young kids and you want to go out to dinner, you have to worry about, are we bringing the kids? We can't definitely go to a romantic restaurant with the kids. If we want to get away even for a romantic weekend, what are we going to do with the kids? Well, in a multi-generational home, they're built-in babysitters. And for the boomers, as the kids move out, who usually moves into those homes? Pets, dogs and cats. And if they want to go away for a week, they have to worry about their children, the pets. In a multi-generational home, what do they have? Pet sitters, built in. So yeah, I could see that it could be really convenient for a lot of people. As a matter of fact, we did a deep dive just a couple of weeks ago on ADUs specifically. And 4 people in the office here, the KCM office, came up to me. One of them was already doing it, and another 3 were looking into doing it. They said, this makes a lot of sense. So it's not going to be for everyone. But if we go to the middle bar, 54% of it saw it rewarding. Ladies and gentlemen, getting a family together and spending time together is not a bad thing for most families. I always make the joke that boomers are petrified that their children are raising their grandchildren. And the thing that makes that joke a little bit funny, it's a little bit true. They want more interaction with their grandchildren. I could see why the boomers find it more rewarding. And I'll tell you, one of the things that I like best when I'm playing with my grandkids is watching my son and daughter-in-law watch us play. That's rewarding to them. No, again, it's not for everyone. 23% say it's very stressful. And we have some people at the KCM office that said to me, Steve, are you crazy? No way. But again, let's not let our personal feelings about anything impact what's the right thing to do for someone else. Affordability is an issue. That's what we're talking about today. Here's a possible solution to the affordability issue. Pooling down payment, pooling money together. Maybe the booming parent has a house to sell and they can put a big down payment. Then they share the ownership of the multi-generational home. The circumstances over the past few years between the 2008 financial crisis and the COVID-19 pandemic have changed the way families are buying homes. According to data from the National Association of Realtors, multi-generational buying rose to an all-time high in 2022, 14%. Compare that to 2021 when this option was at 11%. Ladies and gentlemen, more than 1 out of every 10 houses is a multi-generational home. Don't think this isn't happening. And it's about a 25% increase over last year, 11% to 14%. I'm not saying this is something that could happen. I'm saying this is something that is happening. An analyst at Pew Research, multi-generational living has increased among all age groups over the past 5 decades, but the increase has been fastest among adults ages 25 to 34. What's that age group? That's the age group that they're having children and they're looking to buy a house. Affordability is an issue. Childcare is an issue. A multi-generational home could be part of the solution to both of those issues. This makes a lot of sense, and it's making more and more sense to me the more I look into it. And the government is backing that. They understand this affordability issue. They understand there's a housing crisis. So what happened, the Federal Housing Administration, the FHA, expanded access to mortgage financing for homes that have or will include accessory dwelling units. What are we talking about there, ladies and gentlemen? We're talking about building a second house, either attached or detached, to a current house. A boomer could do that and put his kids in there. Children that own a house could put their parents in the ADU. But the FHA is now expanding mortgaging finances that will include such a dwelling. And also, not just the FHA, in a significant policy change, Fannie Mae has announced that it will accept 5% down payments for owner-occupied 2, 3, and 4-unit homes. This marks a departure from the previously multifamily financing requirement of 15 to 25%. So what are we saying there? Well, let's not talk about 3 and 4 family. Let's talk about duplexes. Perfect multi-generational house. Parents live on one side, the adult children live on the other side. Now they could do that with 5% down. This is happening, ladies and gentlemen, and I do firmly believe in the bottom of my heart, this is a great solution for some to the affordability issue. And what our job is to find solutions. That's what we do. From the Triangle Business Journal, a major newspaper in the Raleigh, North Carolina area, this is what they said to their readers. If you're interested in a multi-generational housing for your next move, you may want to consider talking to a trusted agent in a local lending company to find out how combined finances can help you get the right home for your needs. They are telling their readers, and there's a ton of articles just like this across the country, saying, listen, multi-generational might be the answer. Go talk to your real estate pro. All I'm asking, ladies and gentlemen, is you be ready when they get there. You understand the opportunity they see. Now, when we're talking about affordability, there's some chatter out there that, well, people don't believe in home ownership anymore. They realize that you can't make any money, and, you know, prices are too high, and they're never going to build. Well, like, let's calm down. You know, people say a lot of things. On my Twitter account, people come, or my X account, whatever you want to call it now, they'll come in and say, well, this is what people feel. And I always ask, what survey or study is that information coming from? Or is that just your gut? And usually the response I get from that is crickets. They don't come back. So there are people who have very strong opinions about stuff they know nothing about. You're going to run into some of those people this Thanksgiving. You're going to be at your family mail, and everyone has an Uncle Charlie, right? A crazy Uncle Charlie. He still lives with his mom in his mom's basement. He's 50 years old. He's never accomplished anything in his life, but he knows the answer to every problem in the world. He could, in a nanosecond, solve the Middle East crisis. He just knows if someone would just listen to him, he has the answer. And he has all sorts of feelings and opinions on the real estate market. And he's going to try to share them at the Thanksgiving meal. You're not going to change Uncle Charlie's mind. I get that. What you want to make sure is he doesn't change anybody else's mind that's sitting at the table. You have to be secure in understanding how valuable homeownership is to people. Now, we're going to spend much of December talking about the non-financial benefits. But right now, for Thanksgiving, let's throw some of the financial benefits back at you so you don't forget how people truly feel. America's belief in home ownership is a good investment. Ladies and gentlemen, this year's Gallup poll, this year, 2023, people still believe real estate is the best long-term investment of any of the other investments. And they've believed that for 11 consecutive years. That didn't change in 2023. The American people still believe that real estate is the best long-term investment. So when Uncle Charlie is talking about no one believes in home ownership anymore, they don't believe you can make, this is what I want you to do. I want you to have this on your phone, this chart on your phone. I say, well, Uncle Charlie, Gallup did a survey and it says differently. What survey did you see that said that they don't care anymore? Now, he might allude to some other wacko living in a basement doing a YouTube, show. I shouldn't call Uncle Charlie wacko. He's a really nice guy, but he's just a little off. But he might refer to someone else on a YouTube show. So you're not going to convince Uncle Charlie that people believe this. But there's people sitting next to Uncle Charlie, show them it too. You'll convince them that, you know what? I was hearing some stuff about maybe home ownership isn't the cool thing anymore as far as finances. And that's not the only survey. Lending Tree survey came out this year, recently. And they asked a question to Americans, what do they think is the road to riches? Ladies and gentlemen, real estate won again. I don't want you in the middle of this affordability crisis to think that people don't think that they want to buy a house for financial reasons. That's not true. There are people out there saying that. There is no evidence of that. As a matter of fact, any evidence I can find says exactly the opposite of that. And over time, the people that believe in home ownership as a wealth builder are right. Every 3 years, the Fed does a survey called the Survey of Consumer Finances. And in that survey, they look at the net worth of renters and the net worth of homeowners. And here's the 1, 2, 3, 4, last 5 surveys. The spread, the gap between the net worth of a homeowner and the net worth of a renter is dramatic and growing. Now, that big spike up in the last survey, we're not going to see that spike up again. That trend line is not going to go like that. That had something to do with the 2, what I call unicorn years, where, houses appreciated by almost 20% a year. We're not going to see that again. That line is going to flatten out. But that bottom green line, that's going to stay flat too. So whatever gain that you have and the minimal appreciation we're going to see over the next 3 years is going to make the gap even wider. Now, some people will argue, well, that's because older people own houses and they have more money. Well, no, ladies and gentlemen, the data is not available. It's available yet. It hasn't been worked through. It hasn't been looked at, and we haven't done the graphs on it yet. But the preliminary readings are, no matter what age you are, if you're a homeowner, you have more net worth than if you're a renter. Well, Steve, it's all about income. Well, no, ladies and gentlemen, that's not true. No matter what income category you fall into, you have more net worth as a homeowner than you do as a renter. Now, as we develop those slides and develop those visuals, we'll get them out to you. It'll probably be in the next couple of weeks. But I want you to know, even using this one, that you could say that same thing. The spread is enormous. And somebody might even ask you at Thanksgiving or at some other time, well, what is that just on equity? No, it's not just on equity. The amount of money that people have outside of their house is greater if they're a homeowner than a renter. And let's give you one example of that. The blue line is the number of U.S. small business applications. The green line shows us the capital equity that people have in their homes. So what we could see, and I'm not saying there's a direct causation, but there is definitely a correlation between how much equity people have in their homes and whether or not they feel comfortable starting a business. It's clear as day on this graph. So net worth isn't just about the equity in the house. It's that the equity in the house gives a homeowner more opportunity to do something different, to do something special, to be their own boss. Ladies and gentlemen, some small, very well-known companies in this country started with a home equity loan, some sort, or a refinance of some sort, that led that homeowner to start a business in their garage. I'll give you a couple. KCM. The people that are doing this deep dive. That started in my garage with money I got out of the house. Other small businesses that have done pretty well starting out of their garage? Oh, small companies like Apple. Small companies like Under Armour. Ladies and gentlemen, homeownership really helps people gain the financial freedom that they're looking for. And that's your job, helping them attain that homeownership. Finding ways that you could help them through this affordability crisis, so you can at least get in the game and start building wealth. It's your job. Ladies and gentlemen, please don't believe that people don't want to buy a house, or that the number of people or the percentage of people looking to buy a house is dropping like a rock. Not true. If we go all the way back to 2020, the number skyrocketed right after the pandemic, then came down some. But since 2022, the second quarter of 22, even though interest rates skyrocketed, people still wanted to buy a house. They still plan to buy a house. It's a jagged line heading up to the upper right-hand corner. I get it's jagged. There's some uncertainty. But ladies and gentlemen, it definitely doesn't show that people are losing faith in homeownership. Because if that was the case, that jagged line would be pointing down toward the bottom right-hand corner, not the upper right-hand corner. Though high mortgage rates and the still high prices weigh on home shoppers, recent new home sales data shows that buyers are finding a way to navigate the challenging environment. We're still selling houses. You're doing a great job in a very, very difficult time of doing that. In today's market, our analysis shows that it's slightly more financially prudent to rent versus own, but the dynamic is trending toward owning once more, thanks to the benefit of equity accumulation. First American studies this. And sure, it's more beneficial to rent a house. Right now, it's cheaper to rent a house, I should say, than to buy a house. But that's starting to change already. And don't forget, ladies and gentlemen, over 10,000 houses still sell every day in this country. If you do the math, that's 7 houses that sell a minute. That means while you are on this deep dive, 280 houses sold. Let's get away from the craziness. Let's get away from this wackiness. Let's get back to work. One of the ways you can do that, all right, we did for all of the KCM members on the call that get real talk. What should you do about mortgage rates? We believe very strongly in video here, and that's one of the things that you should concentrate on. Let's get those videos out, and we make it very, very simple for you. Next week, we're going to talk about this home price appreciation accelerating again, and there is some evidence that it is. It's scary, but there is some evidence that it is. So to end, ladies and gentlemen, this is all I want to say. There's some wackiness happening right now. There's no question about that. There are things that will distract you. NAR's leadership team leaving under questionable circumstances. The lawsuits. Ladies and gentlemen, you have no control over those things. Let them work their way out. What you should be doing is concentrating on doing what you do best, helping people. Just go help them. That's what they need. And as I say at the end of each deep dive, and I mean it, you gave me more than a half hour of your life. You gave me 40 minutes of your life. I hope you got a good return on that investment this morning. That's our goal.